Okay, folks, it's time. So, mic is on. Reminder again, quiz on Monday, right? First 30 minutes of class. I sent you the link to the review session. I'll send it again after class today. But don't watch the review session until you've actually reviewed the material. It kind of defeats the purpose. There are lots of past quizzes out there. My suggestion is start with the most recent quiz and work backwards. Don't start with the 1997 quiz and work forward because you might never get to 2019. So, any questions before we start? Yes. It'll be on Brightspace. So if you're taking it on Brightspace, you submit it on Brightspace. But if you are going to take it remotely, you need to let me know. So you've got to be on that list. Otherwise, you won't be able to access it. So let's continue with where we left off. Talking about beta. And we're talking about, in a sense, as I said, I was digging a grave for regression betas. So remind me again what the problems are with regression betas, because as I said, most people still continue to use them. Let's go through the list. What are the basic problems? Yes. They're noisy. So when they're noisy when they're done right, and when they look precise, you got to be even more skeptical because they've been running against narrow index. So that's the first problem. Second problem. They're backward looking, right? Almost by definition, they're backward looking. They tell you the beta for your company as it used to be. And if your company has changed, it's not going to reflect it. Any other problems? What do you need to do a regression beta? You need stock prices and you need returns. So if I asked you what the beta is for a company just going public, you could try running the regression, but there'll be nothing there. You can't do it for private businesses, for divisions of companies. So today, what I'd like to do is offer you an alternative, a way of estimating betas where we still use regression betas, but not in the way people have tended to use them in the past. To lay the foundation, though, I want to talk about what it is that companies do that drives their beta. Why do some companies have high betas and low betas? Think of these as the fundamentals that drive betas. Betas don't come from regressions. They don't come from services. They come from choices that companies make. So to set this process up, I'm going to take a bunch of betas. This is a very old table, but basically what I'm going to do is I'm going to go through the beta that you see for companies here. And with each beta, I'm going to try to tell you a story about why that company has the beta that it does. So let's start at the very top. Bulgari. Why does Bulgari have a high beta? What does Bulgari make? Things that nobody needs that cost an arm and a leg, right? It's a luxury product company. It's a very discretionary product. If you have a lot of money, you go spend on it. Otherwise, you're going to go to Canal Street and buy a knockoff. It has a high beta because it makes an extraordinarily discretionary product. Next on the list, Quest Communications. It's no longer even around. It's a telecom company. Why do telecom companies tend to have high betas? Service is not that discretionary. What is it? Sorry? If it's a telecom company, though, there's a lot of infrastructure, investment, high fixed costs. And usually, how do they fund these infrastructure investments with? They fund them with debt. A lot of debt and a lot of fixed costs. The product and service itself might not be that discretionary. But because your fixed costs and debt, your beta can be high. If you go further down the list, Microsoft beta 1.25. In fact, that beta is closer to 1 now than when I did this. When I first started tracking Microsoft in the 1980s, 1986, 87, the beta was around 2, 2.2. It was a risky company. But as Microsoft has become bigger, its betas come down. We talked about this when we talked about the adjusted beta. This is what Bloomberg is trying to adjust for, is that betas move towards 1. Generally, as companies get bigger, their beta will start to drift down towards 1 for a bunch of reasons. One is that their products and services reach a more diverse audience, a more diverse market. As your products and services spread out, your beta will tend to move towards the market average. In addition, Microsoft, by the time I did this, had accumulated a fairly significant cash balance. Just saying, why does that matter? You have a significant cash balance, we said it's invested in T-bills and commercial paper, the beta which is close to zero or equal to zero. If you have a significant cash balance, again, your beta is going to start drifting down because you now have essentially a riskless asset. If you think about Apple, Apple is about 10% cash and 90% all of the other stuff. That 10% that it has in cash has a beta of zero. So as you start accumulating cash again, beta drifts down. GE, at that time, a conglomerate. Now it's a shadow of itself. It was in 26 different businesses. That is the definition of a conglomerate. You basically try different businesses, you have investments in different businesses. As you look at conglomerates around the world, what should you expect to see happen to the beta of a conglomerate as it gets bigger? What are they doing? They're going into multiple businesses, right? As you go to multiple businesses, your beta is going to move towards one because you're going to start to look more like the market. You're in a sense running a mutual fund inside this company. Holding companies that hold businesses in multiple areas will find their betas drift towards one. ExxonMobil, beta 0.70. Now, when people think about oil companies, they think of them as risky, especially in the last few weeks and months. But if you think about the risk in an oil company, the bulk of the risk for a mature oil company comes from where? Oil prices changing. So when oil prices go up like they have in the last couple of weeks, that's good news for ExxonMobil. But think of what that does to the rest of the market. Higher oil prices mean higher costs to airlines. It's lower profits. So what makes for risk for your company cuts in the opposite direction with the rest of the market. Commodity companies tend to have lower betas simply because of the fact that what they benefit from, the rest of the market might find as a cost. In fact, it can get extreme enough that you can actually end up with a negative beta. In fact, one of the most common questions people get asked in interviews is, can a company's beta be negative? The answer is absolutely. But let me ask you a question. What does a negative beta stock mean? What does a negative beta tell you about a stock? First, think in terms of expected returns. If you have a negative beta, what's your expected return going to be? Risk-free rate plus beta times risk premium, right? If the beta is negative, your expected return will actually be lower than the risk-free rate. You're saying, why would I ever settle for something less than the risk-free rate? What are you getting when you buy a negative beta investment? Yes, insurance. Insurance against some macro risk. And at least with gold, historically, what are you buying insurance against? What's the macro risk that gold has historically been insurance against? Inflation. Inflation affects every other financial asset class negatively. Gold happens to be one of the few asset classes that actually does well during inflation. If that happens, you can end up with a negative beta. Now, if you look across the 46,000 publicly traded companies, a very, very tiny subset actually have negative betas. Okay. Truly negative betas. Many others will have negative betas simply because of something that happened during the 2 years or 5 years of the regression. GameStop at the start of last year, and it's the weekly challenge for this week, ended up with a negative beta. There's no way you look at GameStop and say that's insurance. The reason its beta turned negative was it became a meme stock and people started buying it. And what happened to GameStop had nothing to do with the rest of the market. In fact, it started moving in ways that were against the market. One final example, Philip Morris. Tobacco companies have really low betas. Think of why. Why did I say Bulgaria had a high beta? Extremely discretionary product or service, right? What makes tobacco company beta so low then? if you want a really low beta as a company, make your product or service an addiction. And this is not a moral blow against tobacco. Every company would like to make its products addictive. Let's face it, if Morgan Stanley could addict you to structured products, would they? In a second. Tobacco companies have a product that's addictive, and as a consequence, they tend to have low betas. So I want you to keep that in place, because now I'm going to take all these stories I've told you about these companies and summarize them into 3 determinants of betas. So you come to me with a company and say, what kind of beta should you expect to see from my company? The first question I'm going to ask you is, what do you do? What type of products and services do you sell? Until probably 1990, maybe even till 2000, the dividing line I used to use was cyclical versus non-cyclical. Remember that old divide? Cyclical companies do well when the economy is doing well. Non-cyclical companies have very little to do with the economy. So you're a steel company, a housing company, I would expect you to have a higher beta because you move with the economy than if you're a food processing company. And it worked really well during the 20th century, because the world was divided in manufacturing and was driven by how do you do when the economy does well or badly. I struggle with that distinction now. Is Facebook a cyclical company? Is Apple a cyclical company? Is NVIDIA a cyclical company? I don't know. So I'm going to give you a second way of thinking about products and services that I think is more useful in today's market. The more discretionary your product or service is as a company. You know what I mean by discretion? Your customers can live without it. They can delay buying it. They can defer buying it. The higher your beta will be as a company. We repeat that again. The more discretionary your product and services to your customers, the higher your beta. I'll use the retail business to kind of illustrate this divide. If you take retail, thousands of companies in this space. Let's divide them into 4 groups. You got luxury retail, Gucci, Tiffany, etc. You got department stores, or the few that are still left. You got discount retailers and grocery retailers. I'm just broadly dividing into 4 groups. So given what I just said about discretionary, non-discretionary, you can see which of these 4 groups is going to have the highest beta, right? And it's going to be the luxury retail. Which is going to have the lowest beta? Grocery stores. But let's say grocery stores, and you can see a second divide opening up, because even within the grocery store business, there's a divide. You have Whole Foods and you have Kroger's. Which one do you think is going to have the higher beta? Whole Foods. And let's face it, you will be willing to pay 3 times what you should for eggplant because you want organic eggplant when you're doing well. You're doing badly. You think, who cares? I'm going to die anyway. I'll go to Safeway and buy it at 1/3 of the price. Whole Foods and Sprouts will have much higher betas than Kroger's and Safeway because you're looking at discretionary versus non-discretionary again. I know you've each picked a company. I'm going to assume you have. I want you to think about what your company does. What does it sell? And if it sells multiple products, divide them into groups. Ask yourself, is that product or service a discretionary product or a non-discretionary product? And already you can see the genius of what Microsoft has done, right? You might choose to delay an upgrade and say, I'll work with the old version. But if you have a subscription to Office 365, can you really choose not to renew that subscription? I mean, I have trouble with Microsoft if I don't log into Office 365 sometimes because I can't even open my files. Subscription models tend to be stickier than upgrade models, less risky. Any questions on that first divide, discretionary versus non-discretionary? That's a good question. The question is, how would you categorize? Let me turn it back on you. Can you live without your Netflix subscription? Yeah. Some people say, no, I don't think so. I need to watch a Bridgerton. So this is, I think, with subscription models, the way you create stickiness is with shows that without this, you cannot watch that show. HBO, as long as Game of Thrones was running, had very sticky subscriptions because people did not want to give up their subscription because they wanted to watch that show so much. In fact, the argument that people have against how Netflix puts out shows versus HBO is Netflix dumps the entire season at one go. HBO, you actually have to watch week after week, and there's an argument that week, updating every week, or you have to wait a week to watch the next episode, is stickier than having the entire season dumped on you. So there's probably no one answer I can give about stickiness. I'm probably less attached to Spotify than I am to Netflix because I'm not a big music person. The rest of my family, so if I cancel it, I might hear from them. But that's basically what you're looking for, is how sticky is this model? How much will my revenues hold up if things are not doing well? So let's try this out. We tend to think of businesses as discretionary, non-discretionary, but let's face it, there are some businesses whether they're discretionary or not depends on where in the world you are. Let's take an example. In the US and much of Europe, you can argue phone services become non-discretionary. It's the kind of cost you're going to bear no matter what. So AT&T raises prices. You might move to a different phone service, but you're not giving it up. But there are parts of the world where phone service is discretionary. Only half of all Indians have smartphones, and they have very minimal phone service. But if India does well as an economy, more and more people will not only get phones, but get more updated services, pay more for services. You could argue that phone service is therefore more discretionary in emerging markets and in developed markets because they're more dependent on growth in the economy. Let's take that to the next step. One of the things we're going to talk about today is using the beta for a sector for your company. So if you're a phone company, I'm going to say, use the beta phone companies, the average beta across phone companies. But if this is true, then when you look for the beta for the sector for a phone company, if you have an emerging market phone company, you should expect the beta for that company to be higher than if it's a developed market phone company. So even within businesses, you could have products be discretionary in one part of the world and non-discretionary in the other, and that could drive how you define comparable firms and what groups of companies you look at to come up with the estimate of beta for your company. So that's the first stop. Make sure you check what kind of product or service your company has and how discretionary it is. Let's move on to the second determinant of your beta. Tell me something about your cost structure. When I talk about the cost structure, I'm talking about how much of your costs are fixed and how much are variable. And here's why it matters. If you have a lot of fixed costs, in good times, you make lots of money because every extra unit is almost pure profit. But when you have lots of fixed costs, when things turn bad, your revenues drop, you lose a lot of money. So when you have a lot of fixed costs, what essentially happens is your earnings become more volatile. They become much more sensitive to what happens to your revenues. So as a general rule, you'd expect businesses with high fixed costs to have higher betas than businesses with low fixed costs. Let me give you an example of a business with high fixed costs, the airline business. Think about the cost structure for an airline. Biggest single expense is usually leasing the aircraft, right? Fixed cost or variable cost, absolutely fixed cost, because you can't go to whoever you lease the aircraft from. It used to be GE Capital, was a big lessor, and tell them, look, can I pay you half the lease because our planes were half full this year? It doesn't work that way. Lease cost is a fixed cost. Second biggest expense is usually fuel cost. Fixed cost or variable cost. Once you've decided to put your planes on the ground and you put out a schedule, you don't have much room to economize on fuel costs. Can you imagine being on a flight? Pilot comes out, you're still on the ground. He starts counting the number of people on the plane, says, only 6 people on, yells out of the window, fill it up halfway. Let's see how far we get. There won't be 6 people left on the plane after he yells at. Fuel costs, fixed costs. Employee costs, fixed costs. How does this show up? Have you noticed airlines never have a normal year? They're either going bankrupt or they're making billions. It's almost, they're like, I don't want to insult, mental issues, but they're like manic depressives in the corporate business, right? The upswings are huge and the downswings are huge. That's exactly what fixed costs do to you. They make your earnings much more volatile. So other things remaining equal, the more fixed costs you have as a company, as a percentage of your total cost, the higher your beta. Somebody had a question on Zoom? So let's build on that thing. If this is true, that beta should vary across companies based on cost structure. And here we run into a practical problem, which is if I asked you how much of the costs in your company are fixed costs and variable costs, I challenge you to try to answer this question by looking at the financial statements. When you look at the income statement for a company, it starts with revenues, right? Then you have cost of goods sold. It doesn't break into fixed and variable. You'll have G&A. You can try to guess that these expenses are fixed and these are variable, but accountants don't break costs into fixed and variable costs. We have an information problem. So if I ask you, does your company have lots of fixed costs? I have no idea. Let me give you a way in which you might be able to answer the question. It's not perfect. It's an extremely noisy way, but you can try anyway. Remember what I said, if you have lots of fixed costs, small changes in revenues translate into big changes in operating income. Why? Because if you have a lot of fixed costs, a 3% growth in revenue will translate into a 30% growth in operating income. A 3% drop in revenues is catastrophic. What if I could take the percentage change in operating income you have as a company and divide by the percentage change in revenues? Now, if I do this in any 1 year, God only knows what I'm going to get as an answer. But if I do it across time, I might be able to answer the question, does my company have lots of fixed costs relative to the peer group? So I decided to try this on Disney, but I have a lot of historical data going back to 87. I take the revenues every year, I have the operating income every year. I compute the percentage changes each year in revenues and operating income. The average percentage change in revenues was 11.79%. The average percentage change in operating income was 11.91%. I'm going to divide the 11.91 by the 11.79. I get a measure of operating leverage. The higher that number, the more fixed cost I have as a company. Now, by itself, if I said is 1.01, or in fact, here I've divided into two subgroups, 87 through 2013 is the entire data. But in 96, Disney bought Capital Cities, ABC, it changed itself as a company. So the number has risen to 1.25. But if I gave you that number, 1.25, and said, is this a high number, a low number, an average number? Your response is, I have no idea. So what if I did this for every entertainment company? In other words, I take historical data, compute this ratio. And what if I told you that that average across entertainment companies is 1.35? So we have two numbers here. You have the Disney number, 1.01 or 1.25, depending on which one you're going to latch onto, and 1.35 for the industry. If you trust those numbers, we'll talk about why you might not want to put too much trust in those numbers. What does it tell you about Disney? There is less fixed costs or more fixed costs? And the beta for Disney should therefore be lower. The reason I said you should be careful is that 1.35 average I get for the sector comes from looking across companies. What is the standard error? And that number is 0.2 or 0.3. You might not be able to make this judgment. But there are companies that stand out from the sector sometimes. You know going in that they have a fixed cost advantage or disadvantage. Let me go back to the airline business. In the airline business, there's one company that's been written about more than any other airline company. More cases have been written about this company than any other company in history. You know what the company is? Southwest. Okay. Let's go back and look at what Southwest has done as an airline that makes it different from every other airline. Now, there are a lot of people who imitate Southwest now. So there are a lot of, but when it came in, it changed the business model. When Southwest started, it flew Dallas to Houston and back again. It's a very localized airline. But here's what Southwest did that made them different from the typical airline. They leased aircraft like everybody else, but they leased only one type of aircraft. Does anybody remember what every Southwest aircraft was? It was a Boeing 737, every single aircraft. And it was by design because it meant that they could have fewer maintenance crews around because each aircraft is unique. It reduced their fixed costs. Do they economize on fuel? I hope not, because I sometimes take Southwest. but they're one of two airlines that consistently hedges fuel costs. You know what I mean? They're always hedging. I'm sorry? Okay. As opposed to what? As opposed to most airlines that hedge at exactly the wrong times. You know when most airlines start hedging? Is when oil prices peak. So they hedge all the way down, and then they give up on hedging when they really need to be hedging. Southwest and Singapore Air, the two airlines that consistently hedge. So it's not that they have a cost advantage, but they have predictable costs, right? Because then they can pass it through into the tickets. They're not going back and forth and playing games on fuel costs. On employee expenses, Southwest is a unionized airline, but it's got the most flexible workforce of any airline. It's the only airline where a stewardess says, check me on. You try that with United. You could be surrounded by a dozen. No, not my job. I don't do that. But here was the biggest saving, at least early on. I still remember the first time I took Southwest from New York to LA. I bought my ticket. I forgot all about it. Day before the flight, I decided, look at which airport I was flying out of, expecting to see one of the big three. JFK, LaGuardia, Newark. You know what I saw on my Southwest ticket? It was islip. For the longest time, Southwest did not fly out of JFK, LaGuardia, Newark. It flew out of islip. I didn't even know where islip was. I don't mean to insult people from Long Island, but the only claim to fame is Southwest flies out of it. So I took a cab out to islip, get on Southwest, and I'm flying to what I thought was LA. I get out off the plane, I walk into the airport. There's a huge statue of John Wayne in the middle. I'd landed in Santa Ana Airport. And this was how Southwest flew, right? They flew out of one no-name airport to another. You fly to Chicago and Southwest. I think this is still true. You don't fly into O'Hare, you fly into Midway. Saying, what's the benefit? Have you ever flown United out of Newark? It's a nightmare, right? You land in Terminal C. They're like 150 gates. I think they're for laughs. They fly into gate 3, give you a connecting flight in 135. Some guy upstairs watching you run saying he'll never make it or she'll never make it. But how does United control all these gates? They pay Newark Airport a fee for every gate. Just like British Airways in Heathrow. You're saying, so what? Remember in 2020? When no planes were taking off the ground, or very few, they still had to pay that cost. Southwest early on said, look, we're not going to bear that cost. We're going to fly from no-name airports because it keeps our fixed cost down. Now, over time, Southwest has become bigger, it now flies out of Newark, but it still tries to follow that process of, by doing it, what do they get? I remember right after 9/11, airline stock prices collapsed. There was about 3 months after 9/11, the market cap of Southwest was greater than the market cap of all of the other airlines put together. Because they were able, it's not that they didn't lose money, but they lost far less money than the other airlines because they had less fixed costs. You're saying, why doesn't every airline do this? There is a price for adopting Southwest strategy, right? A lot of business people wouldn't fly Southwest because they had to fly to a big name airport to make connections. So it's not a costless strategy, but it's a strategy by design. So whatever sector you're in, take a look around, because there are companies that go out and say, look, we're going to keep our fixed costs down. You saw this play out in 2020 in the hospitality business, right? The hotels were all saddled with fixed costs. But think about the Airbnbs of the world, which are intermediaries. It wasn't that they were hurt, but they were hurt far less than the companies with lots of fixed costs. So that ratio of operating, of how much does your operating income change relative to revenues is at least a starting point for thinking about how much fixed cost does my company have. Now, I'm not suggesting you can do that for your company because you might not have the amount of history that I have for Disney. But at least think about cost structure in your company and what it's doing on costs that might show up in betas. Which brings me to my third determinant. So what type of business are you in? How much do you have in fixed costs? This is the third question I'm going to ask you. How much debt do you have? You're saying, why does having debt affect my beta? Beta goes with equity investors, right? So when I look at that risk, I'm looking at the risk in equity earnings, net income, earnings per share. When you borrow money, you create a fixed cost you did not have until you borrowed the money. What am I talking about? Interest expenses. I got to make it in good times, not a problem, but I also have to make it in bad times. When I borrow money, I don't care who you are as a company, your equity earnings will become more volatile. So for every company, borrowing money makes equity earnings more volatile, which means your beta should reflect that. And with debt, I can actually be specific about the impact of debt on your beta. And to do this, I'm going to actually split beta up into two different definitions. There's an unlevered beta that comes from the business you're in and your fixed costs. So think about the beta of your company based on the business choice you made and how you run the business. And there's a levered beta, which is the beta that I'm going to observe for your equity. Here's the connection. The unlevered beta comes from your business choices. You tell me how much you borrow, and I'm going to measure that with a debt to equity ratio. And the debt and equity I'm talking about here are market values. No, I don't care what your book values look like, because beta is a market value concept. So as you borrow more, the debt to equity ratio is going to rise. As the debt to equity ratio goes up, your levered beta, the beta that you have for your equity, will reflect the fact that you've taken a business that could have been safe if you chose not to borrow money and made it risky because you borrowed a significant amount of money. You see, what's this 1 minus T doing in there? It's true, when you borrow money, you create a fixed cost, interest expenses. But it's also true that the government helps you out, right? In what way? Interest expenses are tax deductible. What that effectively does is it doesn't make the cost go away, but it makes it less painful. So the 1 minus T there captures the fact that there's a tax benefit to debt. So let's bring it all together. The unlevered beta comes from the business choice you made and what you have is fixed costs. The levered beta reflects that plus how much debt you've chosen to take on. Now, when I ran a regression for Disney, I came up with a regression beta, right? Remember what it was, 1.25. So I have a question. When you run a regression, you get a regression beta. Is that regression beta a levered beta or an unlevered beta? So I'm going to put you on the spot. Where did that come in? Because I took stock prices and I got returns and I ran a regression against the market. We didn't have debt or equity in there. How did it become a levered beta? You're right, it's a levered beta, but how did leverage creep in there?
Because company performance, the company has taken on debt.
But tell me, because the only numbers I used in the regression was stock prices and a market index, right? You want to try? Yeah. Go ahead.
Earnings that you produce already reflect the impact.
But there's one more connection you got to make. The earnings are volatile. So how does that show up? My prices have to become then more volatile. So there's a lot of links I got to make, right? I borrow money, my earnings become more volatile, my stock prices become more volatile. My regression beta uses stock prices, and therefore it is a levered beta. But what's the leverage that's built into that beta? Is it today's debt to equity ratio or the average over the period of the regression? It has to be the average, right? Because I used the last 5 years. If I went out and borrowed $5 billion yesterday, there is zero chance it'll show up in my beta because it happened just a day ago. A regression beta is a levered beta, but the leverage it reflects is the average debt to equity ratio you had as a company during the period of the regression. So I'm going to flesh that out for Disney. The regression beta is 1.25. The average debt to equity ratio during that 5-year period was 19.44%. So basically, I took the debt to equity ratio each year, took the average. There's one final piece you need to solve this puzzle. You need a tax rate. And when we talk about tax rates here, we're talking about marginal tax rates because interest saves you taxes at the margin. Marginal tax rate is not in your company's books, it's in the corporate tax code. And in 2013, the marginal tax rate in the US was 40%. Now it's closer to 25% because of the 2017 Tax Reform Act. But pre-2017, the US had one of the highest marginal corporate tax rates in the world. It was 35% federal plus state and local taxes. So I'm going to use a marginal tax rate of 36.1 because Disney actually very helpfully in their financial statement, we'll come back and talk about this more, told me what their marginal tax rate was. It's a federal tax rate, state, and local. They ended up with a slightly lower marginal tax rate of 36.1%. So this is not an effective tax rate. It's not an average tax rate. It's a marginal tax rate. So there's my regression beta. There's my average debt to equity ratio. There's my tax rate. So I'm going to ask a question. You might wonder, what's the point of doing this? But you're going to see in a minute why this is going to help. I'm going to take the regression beta and I'm going to unlever it. Sounds fancy, but I'm taking out the effective debt by taking the regression beta and taking out the 19.44% effect. I end up with an unlevered beta 1.11. You've taken out the effective debt. The beta obviously will go down. So I'm going to ask a question about this unlevered beta that I think will help you understand what unlevered betas are much better. If you ever watch Jeopardy, I give you the answer, you got to guess the question, right? It's a very strange show. But let's play some Jeopardy. If the answer is 1.1119, what is the question to which it's the answer? And don't say what's the unlevered beta. That's too rough a question. I want something more intuitive. What is the question to which 1.1119 is the answer? Anybody want to try? Okay, the first question you can ask is, what is the beta that reflects the risk of Disney's businesses? Right, an unlevered beta measure. That's the first one. What's the second one? Does Disney, yeah, go ahead. You're still going to have to pay taxes on your income. It's before the tax advantage of debt, right? So your taxes still will be there. But does Disney have to borrow money? Not necessarily. Could Disney have chosen to have been an all equity funded firm? Absolutely. Here's the second question you can ask is, if my company had chosen to be funded entirely with equity, what would the beta be? The answer is 1.119. So let's repeat the two questions. One is, what's the business risk in Disney? What's the beta that reflects the business risk? The second is, what would the beta for Disney be if they chose to pay off all the debt? The answer is 1.11. So Disney can choose not to have debt. They can pay off all their debt tomorrow. The beta will drop to 1.11. But if debt is a choice, they can go to 20% debt or 30% debt or 50% debt or 80% debt if they choose to. So here's the other advantage of having an unlevered beta. If you as Disney ask me, what will my beta become if I double my debt or triple my debt or quadruple my debt, I can now answer the question. The reason we compute unlevered betas is because they now give us a launching pad for answering any question about what will happen to my risk if I choose to borrow more money. So in this table, here's what I have. I have the debt to capital ratio, which is debt over debt plus equity. So obviously that number cannot exceed 100%. The debt to equity is debt divided by equity. So that number is going to increase exponentially as you go from 0% debt to 90% debt, the debt to equity ratio. Because remember, at 90% debt, you got $90 of debt for every $10 of equity. That's a 900% debt to equity. Your levered beta is always based on the debt to equity ratio. So when you look at the beta, when I have no debt, it's the unlevered beta. But as I borrow money, my beta rises, but not just to just a high number. It becomes 5, 6, 7 by the time I get to 80 or 90% debt. You're saying Disney with a beta of 7.5? You can take any company and make its beta any number if you choose to borrow enough money. You know what the typical debt to equity ratio in a leveraged buyout is? It's about 80 to 90% debt. So basically, you're at this end of the table. Right after you do a leverage buyout, your equity is a tiny slice of the overall company. Your beta, at least for the moment, is 5, 6, or 7. You know what having a beta of 5, 6, or 7 implies? It's like building a house on a Caribbean island overlooking the ocean, and you haven't put any windows in. There's no glass in the windows. It's open spaces. The hurricane hits tomorrow, you're sunk. There's nothing you're going to be able to salvage that. Right after an LBO, the worst thing that can happen to you, what's the equivalent of a hurricane? The economy goes into recession, your company gets a shock, no matter who does the LBO and how well it's planned. With a beta of 5, 6, or 7, a recession will feel like a depression. So what's the first priority right after you do the LBO? You got to bring that beta down, right? And to bring that beta down, you got to pay down the debt. That's why right after an LBO, the priority becomes, we've got to bring the debt ratio down before the hurricane hits. Because you can't survive as a company with a beta of 6, 7, or 8. Just too exposed to every macroeconomic risk. So let's list the 3, and if you have any questions. So beta is driven by the choice you make as a business, how discretionary your products and services are, what your fixed cost structure looks like, and how much debt you choose to have. I'm now going to use this to kind of come up with an alternative to regression betas. And I'm going to use a property that betas have that's incredibly useful in practice. Betas are always weighted averages. You think, so what? Let's say I have a mutual fund of the Fidelity Magellan Fund. I have 150 stocks in my fund. And I come to you with the question, what's the beta for my mutual fund? You know what my beta is always going to be? It's a weighted average of the betas of the 150 companies weighted by how much money I've invested. So any of you have investment portfolios and you want to compute the beta for your portfolio, it's very simple. List out every single investment you have, get the beta for each investment, how much money you have in each one, and take a weighted average. So if this were an investments class, that's how we'd use betas. But this is a corporate finance class. We care about companies. You're saying, so how does this help me in a company? Can a company be in multiple businesses? Absolutely. I gave you the example of GE being in 26 different businesses. If I ask you what's the beta for GE, it's got to be a weighted average of the betas of the different businesses you're in, right? Same principle. It's a little messier getting weights and betas, but it's the same principle. That is the opening we're going to use to come up with betas for companies. So I'm going to start easy. I'm going to start with what happens to the beta of a company when it does an acquisition, because you're going to see the weighted average work out right in front of your eyes. And then I'm going to take this process and use it to come up with the beta for Disney that I can use to replace that regression beta 1.25 because I don't trust it. So this was in 1996. Disney bought Cap Cities ABC. It was a huge merger when it happened. Michael Eisner boasted about the fact that he actually negotiated the merger himself, which should already make you a little suspicious about how well it was done. With Tom Murphy, who was the CEO of Cap Cities. We're not going to we'll look at whether the merger did good or bad for Disney, later on. But here I want to focus on a very specific question. Disney's buying Cap Cities. It's going to become one company after it. What's the beta for Disney going to look like after the merger? So let me lead it. There's Disney, the acquirer. It had $3.2 billion in debt, market value of equity of $31.1 billion. And if you add up those two numbers, you get a firm value of $34.3 billion. It was a bigger company. And its debt to equity ratio was 10%. Its regression beta was 1.15. It's equity beta. There's Cap Cities with a beta of 0.95, almost no debt, $615 million, $18.5 billion in equity. If you add up the 18.5 to 615, you come up with 19.1 billion for the value of the firm, debt to equity ratio of 3%. So Disney is going to buy Cap Cities. And the question I'm going to have is, what will the beta for Disney be after the merger? Now, what do we say? It's weighted averages, right? You're saying, why don't we just take a weighted average? Because I haven't told you something. I haven't told you how Disney is going to finance this acquisition. Do you see why that matters? Disney could use all equity, it could use all debt, or it could use something in the middle, because it needs to come up with $18.5 billion at the minimum. Why? Because that's what you do in an acquisition, is you buy out the equity of the target firm. So to answer that question, I'm actually going to go in the opposite direction. I'm actually going to compute the unlevered betas for the two companies first. And this is something I would suggest anytime you have to deal with betas, is before you work with betas, take out the effect of debt, work with unlevered betas, and then you can bring debt in the second step in the process. So here's the first thing. I computed the unlevered beta for Disney, 1.15, take out the effective debt, exactly the same process. And incidentally, the marginal tax rate I was using was 36%. So that's what the 0.64 is, 1 minus the tax rate. The unlevered beta for Disney is 1.08. The unlevered beta for Capsides is 0.93. What does that tell me? It tells me what the beta of Disney's business is and Capsides business. Here's the second step. We know the value of each business, not the value of the equity. This is why I added the debt plus the equity. So if you go back to the previous page, 34,286 and 19,115 are the values of the two companies. I take those values and use them as weights to come up with the weighted average. When you work with unlevered betas, the weights should always be the value of the firm, not the value of the equity, because you're looking at the entire business. This 1.026 is going to be the weighted average unlevered beta for the two companies after the merger. It's true, I haven't brought in the effective debt, but I need to start here. This will be the unlevered beta for the company, no matter how it's funded after the merger. Any questions on this step? Now I have to bring in how they funded this business, this product. If they'd used all equity, so let's do some what ifs. If they'd used all equity to fund this acquisition, that'll be the case if, for instance, they took shares and used them to pay for the $8.5 billion. So every Cap City shareholder gets Disney shares. If they'd used all equity, here's what the company would look like. And they also assumed Cap City's debt, which they don't have to. They could have retired the debt, but let's say they like the interest rate on the debt. They're going to leave it on. The collective debt for the company is going to be $3.8 billion. That's the debt of the two companies. But the equity after the deal is going to be 49.6 because Disney has used equity, its equity, to replace Cap City's equity. The debt to equity ratio will be 7.66%, 3.8 divided by 49.6. And with that debt to equity ratio, the levered beta for Disney, if they'd used all equity, would have been 1.08. They actually borrowed 10 billion to do this deal. Let's see what the actual deal looked like and work out the effects. They borrowed 10 billion, which means out of the 18.5 billion, 10 billion comes from debt. The remaining 8.5 billion comes from their equity. Here's what the numbers would look like. The debt now will be 13.8 billion with the extra 10 billion. The equity will have only the extra 8.5 billion. Why? Because they have to come up with only the difference. That's 39.6 billion in equity, 13.8 billion in debt. The debt to equity ratio is 34.82%. The levered beta after this transaction will be 1.25. Purely coincidental. That is equal to the regression beta we saw on the page, so don't draw any implications from that. Basically, it's just a weighted average, and then adjusted for the debt. In the email that I will send you after class today, I'm going to ask you to tell me what the beta of this deal will be if they'd used all debt. It's a good exercise. It's great preparation for the quiz. You can try different combinations of debt and equity and see what the levered beta will be after the deal. How did Microsoft pay for Activision? So it's an all-cash deal. Where did they come up with the cash? They actually had enough cash on their balance sheet to pay for the whole thing. It's a luxury most companies don't have. You're saying, but if you're using cash from the balance sheet, whose money are they using? Debt or equity? That's an all-equity deal. It's an all-equity deal because the cash is the cash left in the company for the shareholders. It's an all-equity deal. So you can take the Microsoft Activision deal and see what the effect on beta would have been if they'd used debt to fund the acquisition. So any questions on mergers and how this plays out? So it's basic algebra. Work with the unlevered beta first, bring in the debt effect, see what happens to levered beta. Yes.
Another question. Not so much cash. Why weren't they using it?
Well, using it on what? What do you want them to spend it on? Software is a very low capital intensity business, right? So really, there's nothing they could have used in their existing business. Their cloud business is well established. There's no capital that you can throw in there that's going to make the business more lucrative. The software business is Office and Windows. I mean, how many fine-tuning investments you're going to make? The question you could ask is, why didn't they just give it back? They didn't give it back precisely because They were holding it for exactly what they did, right? Once you give it back, remember, it's a pain in the neck to get it back from the shareholder because you got to issue capital. So in this case, the answer is they held it because they're in a business where everything can change overnight. It's the difference between Kraft Heinz holding on to cash. What are you going to do? Come up with a new way of making liquid cheese that lasts forever? There's really nothing, no story you can tell for why Kraft Heinz should hold cash. But technology companies holding cash, I'm not saying I'm going to sympathize with them or agree with them, but I can see why they're doing it. You can be a star today and everything can collapse tomorrow. The entire business can change. And you saw it play out. Having that cash balance allowed Microsoft to acquire Activision at a bargain basement price, if you ask me. Right? Because they paid with cash, they got the company when the CEOs were changing and the management was in turmoil. So it gave them that advantage. So now let's use this to answer a different question. You want a beta for Disney. How do we use these weighted average ideas to come up with the beta for a company? And as I said, if you're in multiple businesses, your beta as a company will be a weighted average of the betas of each of the businesses you're in. I know there are lots of unanswered questions. You say, how do I come up with the beta of a business? How do I come up with the value of each business? That's what we're going to try to do with this. So what's the first step here? I need to come up with the businesses that Disney is in. It's a question that you're going to have to answer. What businesses is my company in? You know what I went, and the process by which I'm going to estimate betas, I'm going to lay out, and then I'm going to try to use this on Disney. So let's say you have a company and you want me to estimate the beta for your company. I don't trust regression betas. Here's the first question I'm going to ask you. What business or businesses are you in? Let's play a game. Let's suppose you're in steel and software. Strange combination, but you go for it anyway. Let's say I'll be back tomorrow. Here's what I do. I go find as many publicly traded steel companies as I can, and as many publicly traded software companies as I can. You know the advantage of publicly traded companies? Each of these companies comes to the beta. It's a regression beta, but hang in there for the moment. I get 100 steel companies. I get the betas for each company. 100 software companies, the betas for each company. I take the average regression beta for steel companies and the average regression beta for software companies. No game playing, simple averages. Is that a levered beta or non-levered beta? What do we say about regression betas? They're levered betas. It's an average levered steel company beta and average software company levered beta. Then I take out the effect of debt that these companies have used. So the typical steel company uses 50% debt. I take out the effect of that debt. I come up with an unlevered beta for a steel company. Typical software company uses 5% debt. I take out the effect of that debt. I come up with an unlevered beta for a software company. Then I come back to you and said, you told me you were in two businesses, steel and software. Can you tell me how much value you get from each business? And your reaction might be, I have no idea what value I get from each business, but I get 70% of my revenues from steel, 30% from software. As a first cut, here's what I do. I take 70% times the steel company unlevered beta, plus 30% times the software company unlevered beta. I now have an unlevered beta for your company. Then I ask you a final question. Do you have any debt? If your answer is no, I'm done. This unlevered beta is now levered beta because you have no debt. If you do have debt, what do? I compute a debt to equity ratio. I come up with a levered beta for your company. Say, this is now your beta. But here's the puzzle. Why did I do this? Because I did not trust regression betas, right? But where did I get the 100 steel company betas? I got them from regressions. All I've done is replace the single regression beta with an average of 100 regression betas. So what's the big advantage? What do you gain by using an average of 100 regression betas instead of a single regression beta? Yes. Remember the law of large numbers and statistics? Every morning I get down on my knees, I look up at the sky and say, thank you, God, for the law of large numbers, because it bails us out in finance and investing all the time. What does the law of large numbers say? I remember sitting in my statistics class, and the statistics professor said, you take 100 crappy numbers, you put them in a pot, you stir them up, you pull the average out, and the average is magically precise. And my reaction was, right. How the heck does that happen? I think I get it now. Remember I showed you the standard error in the betas? What does that tell you? Some of these betas are overestimated, some are underestimated, right? When I average out my mistakes. This isn't rocket science. An average of 100 regression betas is not only going to be more precise than a single regression beta, I can tell you how much more precise. In fact, somebody want to try that? How much more precise than a single regression beta will be an average of 100 regression betas? I chose the sample size as 100 for a reason. It's going to be 10 times more precise. How do you get the 10? Take the square root of 100. So if you have 100 companies in your sample, your regression beta is going to be 10 times more precise. You're saying, what if I have only 25 companies in my sample? It's going to be 5 times more precise. What if I have only 9 companies? It's still going to be 3 times. Anything beats 1. I'd rather have 100 over 25 and 25 over 9 and 9 over 4. But a regression beta is just one slice of history. And it's going to give you strange numbers for lots of companies. So I'm going to try this on Disney. To try this on Disney, I need a breakdown of Disney's businesses. So guess where I went? If you want a breakdown of your company's businesses, might as well start at the source, your annual report, your 10K. And I'll tell you the accounting rule is if you have segments, you're required to break them down if they're more than 10% of revenues. But many companies, some of these segments sometimes don't make sense. But in the case of Disney, they broke themselves down into 5 segments. This is 2013. I'm going to ask in a little while, what would Disney look like today, given what's happened over the last 8 years? So here were the 5 businesses. First was media networks. You know what was in there? It was broadcasting. ABC, Disney Cable. They owned a TV network in India. I forget the name of the network. It's a broadcasting business. Second is parks and resorts. That should be easy, right? That's Disney World, Disneyland. I don't think Shanghai Disney had quite kicked in yet. No. And then there separate arrangements with Tokyo Disney, because with Tokyo Disney, they actually don't own the park. They get management fees for the park, but it's all of that is in there. You know what else I threw in there? Disney has these cruise ships. Those cruise ships were thrown in there because the argument was, hey, the reason people come on a Disney cruise ship is to see Mickey. There's nothing special about the cruise ship, so we're going to throw it in. So sometimes companies make those judgment calls. That's what is in parks and resorts. Studio entertainment. What do you think was in there? Used to be just Disney animated movies. But then you have Marvel, you've got Pixar, you've got Star Wars. They just acquired Star Wars. All of that is in there. It's a very diverse group of studios, all producing different things. Consumer products. Disney used to be a much bigger player in the consumer product business. They used to make apparel and sell it. Increasingly, they moved away from it. Now they license it out. They collect a licensing fee. So that's a consumer product business, is what they make from selling software and clothes. And finally, in 2013, they had started a new business called Disney Interactive. The end game for this business was to make games. At that time, people were playing games on phones and computers, is to make. So 5 very different businesses. My task is laid out for me, right? To get a bottom-up beta for Disney, the process that I described. I have to get the values that Disney gets from each of these businesses. I have to get an unlevered beta for each of these businesses. And then I can come back to Disney, what's your debt to equity ratio? So the first step is fine. So, and Disney actually helped me out because they gave me a breakdown of a bunch of variables based on these 5 businesses. Not every company is good on this. Most companies break revenues down, but Disney also broke down identifiable assets, CapEx, depreciation by business. I could have worked just with revenues, but it's nice to have the remaining information. So first up is I have to get an unlevered beta for each of these 5 businesses. So what do I need to do? I need to find publicly traded companies in each of these businesses, get their beta. It's very similar to the example that I described. So I'm going to take you through the process of how I got the beta for the studio entertainment business in detail, so you can see it work out, because it'd be tedious if I took each one and describe it. I'm describing the same process. I wanted a beta for the studio entertainment business. I defined my comparable firms as US movie companies, because in much of the rest of the world, movie companies are not publicly traded. The US has. So to the degree that the US movie business is different from the rest of the world, and I had about 10 companies. Just saying, that's not very much. I agree. But remember, 10 will still give me a standard error, which is 1/3 lower. So here are my 10 studio companies. And then you look at this list, with each one, your reaction is, that company is nothing like Disney. Remember, I'm not comparing these companies to Disney, the company, I'm comparing it to Disney's movie business. So I have 10 movie companies. I get their regression beta. So that's what the levered beta is. I also get the market cap. They're publicly traded. So that's the share price times number of shares. I get the total debt at each company. And we'll talk about why I include leases. I've done that forever. Now accountants do it for you. And I have a debt to equity ratio for each company. I also looked at how much cash each of these companies had. You're going to see in a moment why that is going to play out. So let me take you to the process of what I'm going to do to come up with an unlevered beta for the movie business. I first looked at the betas and I had to make a choice. Do I want to use a simple average, which is what I talked about? The problem with simple averages, though, if you have outliers, the number is going to explode on you. And you can see this with the debt to equity ratio. My average debt to equity ratio for movie business is 129%, which is absurd. You're saying, what happened? The answer is you have a couple of companies that are, that are pushing this up. In this case, mass hysteria, and maybe the company's name is revealing about where it is. Debt to equity ratio of 478%. Companies will have these immense debt to equity ratios before they implode on you. So I'm going to make a statistical choice. The averages are all over the place. I don't want to work with averages. I'm going to use the median. Remember, in statistics, when you have outliers, the median is a more, dependable number. There are my median numbers. My median beta is 1.94. My median debt to equity ratio is 27%. And in 2013, these are all US companies. The marginal tax rate I used was the marginal tax rate for US companies, 40%. So I have the regression beta for these companies, the median beta, the median debt to equity ratio, and the marginal tax rate. I can unlever the beta. And when I do that, I end up with an unlevered beta that reflects how much debt they have. But the next part is going to sound a little confusing, but hang in there. These are the unlevered betas for these companies, right? But these companies hold some cash. They're about 3% cash, 97% movies. I want the beta for just the movie business. It's called a pure play beta. I want to focus in on just the beta of the movie business. So I do one final cleaning up. I get the unlevered beta that I got for the movie studios, and I take out the effect of cash and say, what would the beta be for the remaining 97%? I know I have lots of layers here. So here's the process. Start with the median beta, 1.24. Unlever the beta, I get 1.0668. So that's just like what I did for Disney. Cash has a beta of 0. I'm trying to estimate the beta for the rest of the movie business, like an algebra problem. The beta that I get for the movie business is 1.0993. So regression beta, unlever, correct for whatever. So if you have a company with 50% cash, guess what's going to happen? Your unlevered beta for the company is going to be way below what the unlevered beta for the business is. I'm cleaning up for that. This is what's called a pure play beta. Now, I prefer to work with gross debt to equity ratios, total debt, and keeping cash as an asset. In Europe and Latin America, people often use net debt to equity ratios with their net cash out against debt. I'm perfectly okay with that. That actually cuts out a step. If I use a net debt to equity ratio, I get an unlevered beta. It's very close to what I got with my gross debt. The difference is actually because of differences in assumptions we make about what taxes do to interest income. But if you want to use net debt ratios, you can just make it one step. So this is what I do with every sector. Incidentally, one of the ways you can see this play out on a balance sheet, if you prefer that format, is if you look at the balance sheet for Disney, the equity beta is the levered beta. The business beta is 1.0993. The unlevered beta for the company is a weighted average of the beta the business it's in and the beta of cash. So if you get confused, just put out the balance sheet so you know which beta you're talking about. The levered beta is always an equity beta. The unlevered beta can either be the unlevered beta of the whole company or just the business the company is in. My focus is on the unlevered beta of the business there. Any questions on mechanics? Yeah.
Yeah. It's probably marginal, but should we only be excluding excess cash, not all cash?
No, cash has a beta of 0, even with part of operations, right? So let's have cash as part of operations. I'm a retail company, right? That cash is still invested in T-bills and commercial paper while it's sitting around. So whether I need it for operations or not, its beta doesn't go up. It's still invested in a riskless asset. So from that perspective, to me, the divide is not between operating and non-operating cash. It's just wasting and non-wasting cash. Any other questions? So that's basically what I do. So I'm going to go back 2 pages. And as I said, it'll be tedious for me to do this on everyone, but that's basically what I did for all 5 businesses. But I'm going to take 2 of these businesses and take you through the process of some roadblocks I ran into, because you might run into the same roadblocks. The first was when I looked at media networks, I looked for big broadcasting companies. When you think about big broadcasting companies in the US, you think of ABC, NBC, CBS, and Fox. And in 2013, here's the problem I ran into. ABC was owned by Disney. NBC was, I think, on the verge of being transferred from GE to Comcast. CBS was part of Westinghouse. And Fox is part of this nightmarish company called News Corp, where you can't even find things. It's a big one. You see where I'm going? I could not find companies that were in the broadcasting business were publicly traded. They were all parts of bigger companies. I'm in trouble, because what does law of large numbers require? Large numbers. So here's the first thing I do when I get desperate. Many of you will get desperate when you do this for your company. I went up and down the food chain. What do I mean by that? Broadcasting companies don't exist in a vacuum. There are companies that feed in and feed out of the broadcasting company. I'll give you examples of 2 companies I included. One was a company called Kingwood. If you've never heard of Kingwood, it syndicates TV shows. They used to own the rights to the Oprah show and to Jeopardy. So what they do is they syndicate the show, they sell it to the broadcasting companies. And if the broadcasting companies are doing well, they do well. If the broadcasting companies are doing badly, they do badly. Now there was a company called Nielsen. And in 2013, Nielsen's biggest business was providing TV ratings. It made money on that service that it provided. Again, what I'm looking for are companies that do well when broadcasting does well and do badly when broadcasting does badly. So if you look at these 26 companies, you're going to look at something, what is that? I've never heard of that company. It's a company that feeds off the broadcasting business. So I did for that, and the unlevered beta for broadcasting is 1.03. Then I went to theme parks. And I went to look for publicly traded theme parks in the US. And I knew I was in serious trouble because 2 companies popped up. Anybody want to guess at least one of the 2 companies? One is a company, Universal actually was not publicly traded and separate at that time. One was Six Flags, which at that time was facing catastrophic debt risks. And the other was this Midwestern Cedar something. I know if you're from the Midwest, you probably know. So basically, there were 2 publicly traded companies, even if I took both of them. And 2 is really pushing the limits of the law of large numbers. That's a really small number. So here's the other thing I do when I get desperate. I said, why am I staying US focused? Remember, betas are essentially comparable around the world. It doesn't matter whether you're in Africa or Latin America or Asia, because here's why. You take every part of the world. What's the average beta across all Asian companies? 1. African companies, 1. I went global. And there are at least, if you look at Europe, there are quite a few theme parks listed. The Lego parks, for instance, is a publicly traded company. I got a much bigger sample size. What I'm trying to say is I often hear from people saying, I read your bottom-up beta approach, or I saw you do it in class. It's not going to work for me because I can't find comparable companies. And my reaction is, you haven't tried hard enough. So don't define your business too narrowly. Don't define your geography artificially. And you'll always find comparable companies. You know, the other excuse you get is, right? My company's in a new business. There are no new businesses. There are new ways of delivering whole businesses. Did Uber invent the car service business? I don't think so. In fact, car service didn't invent the transportation business. There were horse carriages before, and all the businesses related to it. Did Facebook invent the advertising business? Of course not. So don't let a platform become your business. Facebook is not a social media company. It is an advertising company. Google is not a search engine company. It's an immense advertising company. It gets 93% of its revenues come from that search box. Step back from the actual description of the company, and you always get enough companies. So that's basically how I got the unlevered betas for the 5 businesses. This is the toughest part of getting the bottom-up betas. And I'll help you out. I'll actually, on my website, I compute unlevered betas by business for 94 different businesses. They're very broad because I have to be broad to get enough companies for 46,000 publicly traded companies. I give you the betas for global companies, US companies, emerging market companies. So you don't have to reinvent the wheel. You have a steel company, I have an unlevered beta. As long as you trust me with my unlevered beta, you're welcome to use it. But this is the part of the process which lays the foundations for bottom-up betas. So now I have the unlevered beta for my 5 businesses. I'm sorry. I've got to come up with weights for the 5 businesses. What do I have? I know what revenues they get. Disney gave me that. And if I'm in a hurry, I could use revenue weights. But here's the problem with using revenue weights. I'm treating $1 in revenues in the theme park business as equivalent to $1 in revenues in the broadcasting business, in the movie business. You're saying, what's the big deal? Margins vary across businesses. Remember the steel and software example I gave you? That 30% of software is probably going to account for 80% of your income because the margins in the software business are 40% or 45%, but in the steel business, that's 6% or 8%. The problem with revenue weights is they don't reflect the values of the business. It would be nice if I could somehow convert the revenues I have by business into values for each business. And I think I can pull it off. Remember those publicly traded companies I showed you, the studio companies? When I did that, I actually also computed what multiple of revenues each of these companies trades at. To do that, I took market equity plus debt minus cash. That's called enterprise value. So equity plus debt minus cash divided by the revenues, and the median multiple that movie companies trade at is 3.05 times revenue. So for every sector, in addition to getting the betas, I got this multiple of revenues. A typical movie company trades at about 3.05 times revenues. Do you see where I'm going to go with this? I took my revenues by business and I multiplied by that median. So if you look at the movie business, I'm taking the 5,979 million that Disney got from. So I multiply by the business, I get an estimated value for each business. Those are the numbers I'm going to use to weight the businesses. And based on my estimates, it looks like Disney's about 49% broadcasting, 34% theme parks, 13% movies, only about 2% consumer products, and 1.25% gaming. You take the weighted average of the unlevered betas, the unlevered beta that I get for Disney as Disney's operating businesses is 0.9239. It's a strange way of phrasing it. You say, what do you mean Disney's operating businesses? Because Disney does have a cash balance. If you ask me what the unlevered beta is for Disney as a company, not just its operating businesses, I would bring in the fact that they have $3.9 billion in cash. And the unlevered beta for Disney's as a company would be 0.8978. So all I'm doing with that EV to sales ratio, enterprise value sales ratio, is converting revenues into estimated value. You're saying, why do you use revenues? I could have used EBITDA and a multiple of EBITDA if you want. So you can use whatever scalar you want, but it's better to work with values when you do beta, unlevered betas than with revenues. Last step. I have an unlevered beta for Disney as a company. I have an unlevered beta for each of Disney's businesses. What's the last step? I need a debt to equity ratio, right? To come up with a levered beta. And here I ran into a problem that all of you are going to run into. These are market value numbers. I can tell you what the total debt and market equity is for Disney as a company. And that debt to equity ratio is about 13.1%. I'm sorry, 13.1%. So that was easy, I could give it. But if you ask me what the debt to equity ratio is of the theme park business and the broadcasting business, remember, they're not traded. And Disney doesn't break down the debt by business. So to show you how I've changed my thinking over this, the Applied Corporate Finance book that accompanies what we're doing in this class, the 2013 version, is the 4th edition. The first edition came out in 1997. In the first edition, when I broke Disney down by business, and I had the debt to equity ratio for the company. I said, I don't know what the debt to equity ratio for each of these businesses. I'm going to give them all the same debt to equity ratio. Very lazy solution. The solution where my argument is there's no. But as I was doing it, I knew this wasn't going to work because if you think about it, the theme park business is an infrastructure business. The movie business is not. I would expect the theme park business to have more debt than the movie business. So I've been, since that first edition, I've been thinking about ways in which I can come up with the debt to equity ratio for each business. And here's my latest iteration. I'm not quite there yet. Remember Disney broke down their businesses by identifiable assets? It's the physical assets invested in each business. I assume that the debt could be allocated based on those numbers. In other words, if you're a business with a lot of identifiable, I know it's a complete assumption, but I've taken the debt and broken it down. So I've taken so that came right out of Disney's financial statements, and I've allocated the debt to each business based on that. Once I allocate the debt, remember I got the estimated value for each business right here by multiplying. You subtract out the debt from the value of the business, you get, so in a sense, I'm estimating the value of equity in each business, the value of the debt. Yep.
How do you allocate those assets?
No, those were given. So I didn't have to allocate them. If they were not given, then I'd have to use some other scalar. Yeah, it's in the footnote. So Disney actually broke down their identifiable assets. If you don't have that, then you have to figure out something else to base on. You might look at industry averages. There are lots of different ways you can approach it. You're saying if you're in an industry where other companies are using a lot of debt, you should too. So there is no perfect solution. Every one of them comes with limits. But I have a debt to equity ratio that varies across businesses. The consumer product business is an insanely high debt ratio, right? And normally that would trouble me, but remember what I said, Disney's consumer product business has become, it's become a licensing business. Very predictable revenues. So I'm okay with that high debt to equity ratio. I'm almost there. I've got the unlevered beta for each business by looking at publicly traded companies. I've got the estimated value. I've got the debt to equity ratio based on this allocation. I come up with the levered beta for each business. I have a luxury of riches here. I can tell you that the levered beta for Disney is not 1.25. What you saw in the regression, it's closer to 1. It's 1.00. I think that's a much better representation of Disney's true equity risk. But I also have given you the beta for each of the 5 businesses. And if I take the risk-free rate, remember the risk-free rate is the same for every business. The equity risk premium is the 5.76%. I get a cost of equity for each business. And you can already see that Disney has a cost of equity of 8.52%. But the costs of equity vary across businesses. So I'm going to ask you a question, and I think this is one of those questions that I see companies getting wrong all the time. So I want you to think about not just the answer, but why it's the answer, because you have to be ready to explain it to other people who do it differently. And to set this up, let's assume that you want to be the CFO or the movie guys. You pick a role. Why do you guys be the movie guys? Because it's so much more fun. I'll be the CFO. My work is to say no whenever you show up. So you come to me with a movie project. Heaven's Gate 2 or Lone Ranger 2. Remember that Lone Ranger movie that Disney made with Johnny Depp as, what is it? He was the sidekick. I don't know. For me, whenever I see Johnny Depp, I think drunk pirate. Don't ask me why, right? I mean, it's no matter what role he plays, drunk pirate again. Partly because I think he's drunk most of the time when he's making his movies, but now he comes across it. So Lone Ranger 1 crashed and collapsed. I think Disney wrote off 150 million. So ready? You're the movie person. You show up in my office. Say, we have a new movie. I say, what? Lone Ranger 2. I get ready to throw you out of my office. Say, no, this time we've looked at the numbers, which tells me a little bit about last time, but let's not go there. So we've looked at the numbers, we've hired these 3 MBAs to work through the numbers, and I think we can make a 9.5% return in equity. No movie guy ever talks like this, but act like you do. You see why I picked the 9.5% return on equity? It's higher than the cost of equity for the company, but it's lower than the cost of equity for the movie business. So here's my question. When I look at a project and I look at the return on that project, should I be comparing to the cost of equity for the company? After all, it's coming up with the capital. Or should I be comparing to the cost of equity of the business that project is in? What do you think? The business, right? And it doesn't make sense because if you're in multiple business, you have risky or safe businesses. If you use a company's cost of equity, you know what's going to happen, right? Safe businesses are going to end up subsidizing risky businesses. Over time, the safe businesses are going to get smaller and disappear. And you're going to end up with a bunch of risky businesses. You know, what the heck happened here? It's completely predictable. But it's amazing how many companies, multi-business companies, still have one hurdle rate. Your cost of equity should reflect the business you're in, not the, in fact, I'll make this general statement. The discount rate for a project should reflect the risk of that project, not the risk of the entity looking at that project. It's not, so you can't, as a safe company, make risky projects safe. So I'm going to close with that. Half of all companies globally, multi-business companies, use one hurdle rate. To me, this is common sense. So what is it that you think? So after the quiz, we'll start with the question. Why do companies insist on using one hurdle rate when clearly the logic, the intuition, everything should lead them to have hurdle rates that reflect the difference? And guess who the worst culprits on this are? Banks. Banks for 40 years have used one cost of equity across businesses. And you can see where it's led them. You can see what's happened to banks over the last 40 years in terms of business mix. And again, it was completely predictable when they made that choice up front. So I will see you on Monday, first 30 minutes quiz. And after that, there will be class. So don't go away after your quiz.
Professor, I have a question.
Yep.
On slide number 178, when you add up the estimated equity, it doesn't sum up to 121. It actually sums up to 119. Right here, yeah.
Oh, because the 121,878 is actually the value of the equity that is the actual market cap. What I'm getting as allocated equity is based on my estimate. So it's actually a good point you're making. You heard of sum of the parts valuation? This is actually a sum of the parts valuation. And if you're getting a different value based on the businesses, it can either be that the company is undervalued or you screwed up in valuing one of the businesses.
Okay.
So,
so should it be 100? Yeah.
So this 121,878 comes from actually share price times number of shares. All of the estimated equity is only for the divisions. For Disney, it's the actual equity.
Okay, thanks a lot.